All right, today the S&P 500 fell 13 points, a little bit more than 13 points. Its first two-day losing streak since that Christmas Eve low point. How bearish is this, and is this what we expect? So I'm going to break down that market outlook in today's move and how it fits, and then break down the busy week we have ahead and what we can expect to see by the end of Friday. I'm also going to look how to trade an earnings announcement on the big name that we have coming up later this week. So let's go ahead and get started. Today is Monday, January the 14th, 2019. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator first. You can see we're starting to get that near-term pullback we talked about the last few days today. And again, it's, put in context, this two-day decline that we've had. Both days we finished higher than we opened, but both days are small declines, and it's kind of normal when you're in a bullish move here over the last few weeks and you start to pull back a little bit. Right? What would be more concerning is you had these big kind of down moves coming off these highs, and that's not what we're getting, at least not yet. The blue line turned down, not surprising. Can't stay strong forever if you're not at least getting gains. Momentum line fell down, but not to over extreme levels, and that's really only what matters when you're in a bullish trend, because again, the intermediate line is above 50, so technically we do have a bullish posture. Now, keep in mind, while we do have dark green shading here on the chart, which is what we're shooting for when you're bullish, you don't have the green line. The moving average isn't green, which is that kind of secondary confirmation, that we are indeed bullish. So and again, we're coming off of really low levels on the intermediate line, which typically when we get to the midpoint of a chart coming from such low levels, you tend to get a hiccup there. You don't ever usually go from very low levels to very high levels, and I don't think that will be the case again here. So the expectation is we'll get a little bit more of a pullback, and it will not be that big of a deal. I know the tenor and tone across media today, no matter what media it is, was pretty bearish, right? Oh no, we're getting selling, and what's going to cause this recession, and the reality is that's as big of a drop that we had, and that puts it in context. Coming off that low point was really not that big of a deal, which is pretty darn normal for when you get pulled. You can't go up every day, so you are going to get the blue line back below 50. And remember, when the blue line gets above 50, while you have a weak bullish posture, the near-term runs don't last as long as expected. They don't last at 7 to 12 days as we normally expect them to. The blue line above 50. So we have how many days we have? This was at 49. So the next day here we got the 76.5. So 1, 2, 3, 4, 5. Let's see, 1, 2, 3, 4, 5, 6. 6 days up here with the near-term line, the blue line, up above 50. So it's not that, everything so far has been pretty darn typical. I did see something on Twitter about how, it's typical that when you get a 20% or more drop, that you hit resistance at a 50% or 10% gain. And so here's where we are, right? That's where we're at. And I would add to that, when you 10% or more below the 200-day moving average, like we have been multiple times in the past, then you tend to hit the 50-day moving average and way back up. Simple as that, right? That's just the normal, typical behavior that we're currently seeing right now. So nothing really abnormal the last couple of days. In fact, we haven't even gotten really below the low point of the high day, right? Of the highest high day, right? Which is a couple days ago. You can see the short-term pullback here on the Dow. The Nasdaq's actually getting a bullish intermediate confirmation signal. Again, you don't have the intermediate line up above 80, so it's not strongly bullish. That's what strengthens that signal. Another thing that strengthens the signal is the near-term line below 50, so you're pretty close on that. But again, not as much of a pullback here. We don't have a strong enough trend established yet that we can use these really short dips as buying opportunities yet. And then the Russell 2000, same thing, very oversold. In fact, it did drop. Well, it got to 6%. They tend to be more extremes in the momentum line on the Russell because it's higher beta. But you get the idea of how more bearish again. Did not quite get above the low of a couple days ago. And you see the near-term line also not quite below 50 yet either. Remember, the near-term line did not get below 50 on the Russell. So this has kind of been one big near-term run here because of how bullish we were, and then with the one down day that we've had this whole time. Now we've had our second down day during this since Christmas Eve, since the cluster of clusters that we got at the end of last year. Alright, so you can see over the last 3 weeks we got to the 50-day moving average, and it's still declining. It's still below the 200-day moving average, so this is the typical behaviors. Now the idea is we'll pull back, right? We'll pull back and form a secondary low point here within the next couple of months. Where the next low point is, considering we dropped so far below the 50, I highly doubt. Again, if I take a look at here, let's show the MACD here, and let's compare current prices to the 50-day moving average. Oops. Over this long term. So how far away we got from the 50, and let's go back a little bit for some context on this. So you can see we did in 2008 when we really fell off a cliff. We really got down, but you can kind of get an idea of how far down we were below. Back again, you look at this level, the lowest point we got below the 50-day moving average right here. The MACD was 117 on 188 or 1880 close. So if I were to get my calculator out here, 117 on the MACD out of 1880 on the close. So we were over 6% away from the 50-day moving average at its lowest point. Here we got down to 238 points out of at the time 2416. So we were almost 10% below the 50-day moving average. So that's a significant decline. And the other real steep declines that we had, for comparison's sake, we got down 122 points here, so a little bit more than 10% below the 50-day moving average in 2011, because again it was 122 points, negative MACD at the bottom. The S&P at the time was 1123, so it kind of gives you an idea of how far how big the gap was relative to the current levels of the S&P. So it's a pretty steep decline. Back then, similar, as that was a little bit more than 10%, it was a little bit less. So this is very similar. And again, if I were to put on a logarithmic scale here, give me a second to do that. Oops, keep hitting the wrong buttons here. There we go. Use a log scale. It doesn't change the absolute figures, but you kind of get the idea and see how steep that was here compared to where we are here. So very steep declines. These didn't get to lower lows, at least on a closing basis. The 2011 we didn't get. It took a couple of months, but we eventually got the move back up to the 200-day moving average and the crossover. You would venture to guess similar thing here can occur because again of how far down we dropped so hard. I mean, that's to get below the 200-day moving average is one thing. To get below the 50-day moving average because it moves faster, that means you have a much steeper decline, and you'll tend to get the bounce backs to the 50 pretty quickly, like we have in 3 weeks. And then now we'll consolidate more, we'll base more, and there'll be some volatility, there's some big up and down moves, but we'll base more as we try to figure this out. And then when we get back up above, then things will get more bullish as we see back here, and so we'll just have to see that occur again over here on the right. Alright, let's take a look at the 3 green arrow chart. You can see we got 3 green arrows still on the MACD and stochastic and the moving averages. Now the 8 is above the 17, but neither one of them below the 30, so keep that in mind. That's usually a sign that we'll hiccup like we saw over here, and over here too you can see a similar pattern. So it's usually a sign that we'll hiccup here, and so there's a good chance that will lead to some weakness, as we've seen when we come off the stream lows and MACDs. We get up a little bit above it and then we hiccup or we pull back down. So I fully expect something similar to happen again. All right, now we'll take a look at the intraday chart, and you'll see, look how flat. Someone said that this was a trading range. It's like, no, this is not a trading range. It was just sideways. We're at resistance. That's what this is. We're at resistance. We're at 260. Eventually, 260 is going to, in the next couple of days, is going to become the high of the 4-week range. 250 right now is the midpoint. I venture to guess that's probably going to fall down to around 255, 256 in this area is where that midpoint's going to fall down to. So we can fall 10 points in the S&P and still, over the next week, and still be trading in the upper half of the 4-week range. So keep that in mind. That's why we're going to have some volatility. We could fall back into the lower half of the chart and still not be pushing to new lower 4-week lows anytime soon, at least not for more than a week, right? More than a week, the low point's going to start moving up to these lows, right? So that kind of gives you an idea. Usually this won't contract too quickly when we're bouncing. Usually the 4-week range contracts at the end of bullish trends, and that's when we get an idea that we'll break to the downside. So there could be a lot of ups and downs, keeping the low point down at a good distance below the below the 4-week high point. You know, if we were to test in this 245, 240 area, that would have served to keep it down for a while, the 4-week low, and then give the ability to pop back up towards 260 or beyond and keep the range relatively wide. That's typical behavior at bottoms, right? Because if we don't form a low point down here, then it will start tightening up pretty quickly, which is not typical of big declines below that produce death crosses, and then the subsequent bound. This is not typical. That's a tightening of the 4-week range is not typical behavior when you're trading below the 200-day moving average. All right, let's look at the volume in the trading range today as we are sitting at this resistance level. So you see today's range under 2 points again, which is less than 1%, very, very low volume, less than 70 million shares trading hands. So put that in context. You see the volume starting to really, I mean, it's down at the lower end of the 52-week range. The ATR down at the lower end of the 52-week range for the average. The ATR, relative ATR is really dropping back down, getting below 2% again. So I mean, again, you can see as we consolidate into this low point, you will get pullbacks in these levels because the ranges will get smaller. On the subsequent bounce, they tend to not be so big. The moves tend to not be as big as obviously the ones that produce the surge low point is. So these will still continue to move their way lower as we're basing, and then once we can see, once this again back here in May 4th is when the new intermediate trend started. We had that bullish long-term market sentiment run for multiple months. You can see we were already dropping for quite a while by the time we started that move, where we got the intermediate posture bullish and the green moving average on that market forecast chart. You can see if I were to pull back up to that chart, there's May 4th right there. See, we got the green line on the moving average, and we got the dark green shading on the market forecast. So that's when the trend started over there, but by then the trading ranges and the volumes and volatility were all falling. So here's May 4th. You can see that's when we finally fell down below the 90% mark on the VIX to its 90-day alternative. So we're not there yet, as we're bouncing up a little bit today into the upper, up into bearish territory, up towards 1. So we're above the 95%. It's in bearish territory, but again, that doesn't mean necessarily that we're going to be heading down now we're going to fall off a cliff. It just means that we haven't entrenched ourselves yet in the new bullish trend yet. We're still forming the base. We're forming the low point while we're below the 200-day moving average, with the surge low first and then a subsequent retest low that we expect to see within the next month and a half or so. So what do you think? Do you agree or do you disagree with that outlook? Love to hear your thoughts. There's a link popping out in the top right corner of your screen. Click on that link up there, then hit either agree or disagree. If you click on disagree in the poll, scroll down to the bottom of the comment section. I want to hear your thoughts. What do you see that would suggest otherwise from what we just got from our routine look at our charts here? So let me know down in the comment section below. Would love to share your thoughts and ideas and what you're seeing with other market scholars. Whether it suggests maybe you have a more bearish posture than this, or whether you think that we're more bullish. Either way, share your thoughts down below. Remember, subscribe to our YouTube channel. There's the red subscribe button popping out in the bottom right corner of your screen. Click that button to subscribe. Click the thumbs up icon down below the video. That tells me two things. Number one, you got something out of the video today. And number two, you want me to do, or you want us to do the video again tomorrow. It's a quick, really easy way. Every time you like a tweet, you like a Facebook post, that tells us you want us to do the video again. If you, for whatever reason, you don't want us to do the video again because, man, this one sucked today, then don't click on anything, right? That's how we know. Those are the things that we watch for. So click that thumbs up icon. You can do that right now down below. Also, comment down below, what did you get out of the video today? What was something that you learned or got out of it, or whether it's in this initial segment of the market outlook or after this when we go through the trade idea and what was driving price action today. Join our daily market outlook email list. There's a link popping up in the top right corner of your screen. Click that link up there to subscribe. Follow me on Twitter for more content like this throughout the day. Whether I retweet something or put something out there myself, I do that in between videos, so make sure you follow me there. Join our Market Outlook community that we created on Facebook, where we have like over 1,000 people like yourself who watch these videos, and you can come on, join that community. And if you want to like our Market Outlook tweets and Facebook posts, you can do it right here from the blog. That's why you're watching. Scroll down below, click that heart. It opens up a new window. You click that like button. Click this image. It takes you to your Facebook page. You can like it from your Facebook account. Tonight's Market Outlook post there. Remember, the more you do that, the more you're telling Twitter and Facebook and their algorithms that you want them to keep you want them to keep sharing our stuff with you, because they don't share everything because depending upon how many people you follow. So that tells them you want our stuff to keep sharing our stuff with you, and you'll continue to get it. You can also like it right here on the blog. Remember the calendar here up on the right of what classes we have coming up. My options class is tomorrow. Then Wednesday morning we do our inventory style trading for options. Tomorrow morning we have Brandon's really popular dividend growth investing class, so make sure you check that out. For premium subscribers, make sure you're checking that out. You can see all of our other classes when you go to our events link at the top of the screen. Remember, you can subscribe to our site for free. The classes obviously are not for free, but as you are a free member, in addition to coursework that we general coursework that we'll be putting out there, you can also participate in our forums, in the Market Outlook forums. There, you can do that for free on our site as well. Alright, let's take a look at what's driving the price action today. Remember, there was hardly anything on the calendar today. Citigroup came out with earnings, kind of the first earnings from the major banks. We have more all week long. This is the week we kind of kick off earnings season, so keep that in mind. But in terms of what's driving the price action, again, we are heading into resistance on a technical level, with weakness in crude oil, especially late in the day, down 2% here. There was pressure on risk assets, and gold, the dollar was down a smidgen, gold was up a smidgen, preferred stocks doing okay, foreign bonds doing better than U.S. Treasury bonds. High yield bonds were down today. If you look at the U.S. bonds, this level, so it's not too often where stocks and bonds both go down to the same degree. You have usually they kind of move up. They go up. Long-term Treasury bonds will be up on days stocks are down, but not the case today. You can see crude oil, small cap stocks, even dividend stocks joining the selling. Emerging markets falling behind developed markets more. They've been bouncing quite a bit here lately during this bounce. There's your treasuries down, some along with high yield corporate bonds, and everything else kind of flat. Small gains in these risk safe haven type asset classes, but small moves, bigger moves than not really small moves on an absolute basis, but small moves on a relative basis, considering where volatility is at. So keep in mind that if you're looking at the S&P 500, we're down 0.5%. That might have been a pretty decent sized move in 2017 when volatility was very low, or even last year in the summertime when volatility was very low. But that's not a very big move at all right now, considering where volatility has been in the past few months. So context is key there, and when the volatility is still at relatively high levels, you're still going to get relatively bigger moves, but that are going to be small in comparison to the moves that produced this significant drop below the 200-day moving average and low point. So it seems big. Because we're so used to 2017 kind of being the norm, the low volatility environment. We're used to that to being the norm. That is not the norm. Last year's the norm. Last year we had a lot of volatility. Now the volatility might have been bigger, but the frequency of volatile moves in the markets was very normal last year. The only reason why they were bigger than normal is because we didn't get anything in 2017. So you kind of had double the volatility last year compared to 2017, but not in terms of frequency of moves, but in the depth of the of the moves that we did get. So they all kind of built into each other last year. So today, really not a lot on the calendar and not really driving the price action. And if we take a look at the sectors and how they perform today, so let's just go to the sector watch list here, and then over here we'll pull up sector comparison and change this to a custom time frame for a day. There we go, and look at 10 minutes. All right, and you can see financials did okay today. Industrials were flat, and pretty much most everything else was flat. The bigger movers to the downside was obviously utilities. Utilities, especially utility out in California, really struggling, down 2.25%. Now keep in mind that was one of the biggest winners during the pullback. So it had some outperformance to give back. You can also see healthcare, technology, discretionary all lagging the markets, but higher beta names, cyclical names that you would expect to lag. They've also been two of the bigger winners during this bounce since Christmas Eve, and so that not surprising that you'll get a pullback. If I were to take a look here at the low point since Christmas Eve, so it was like right there, and then we retested a new low on which for some sectors did get to new lows like financials on the day after Christmas. Since then, you can see energy stocks are up 15%. Industrial stocks over 13%. Utilities have been lagging behind. They are now up only 2% off of that low point. The broad market's up 10%. Technology here lagging behind a little bit. Here is healthcare and financials also lagging the market during the bounce up higher. Consumer staples, is another safe haven area, up 6% but lagging. There's real estate making a strong move up higher here today, up to 12%. Gain since that low point. Discretionary pulling back, communication services pulling back. So technology lagging behind those two other cyclical areas along with industrial. So those have been your big winners, and they're gonna see a pause here. They're gonna see a pause during this little decline. In fact, from this low point on January the 3rd that we had, you've industrials, technology, discretionary, communication services, energy all leading the markets, and then your safe havens all lagging, and you can see utilities now only flat off of that low point. So those are the ones that did well. They're going to pause during the pullbacks. They're going to pause probably more during the pullbacks, give back a little bit more because they have more to give back. And remember, there's going to be a lot of economic data coming out in the next few days. If you also look at the earnings calendar. So tomorrow's the Empire State Manufacturing Survey and PPI. On Wednesday you have retail sales, the housing market index, import and export prices. Then we slow down with the Fed's balance sheet beige book on Wednesday and Thursday, and we finish the week with industrial production and consumer sentiment. From an earnings standpoint, you can see Wells Fargo, JP Morgan, Delta, United Healthcare, all with earnings tomorrow. Here on Wednesday, there's Alcoa. You can see Alcoa is typically one of the first to come out. You can see Bank of America, Goldman Sachs, a lot of financial sectors. CSX, Kinder Morgan, Alcoa, so there's some industrial type names due as well. This would be Thursday. You can see American Express is due on Thursday, Netflix on Thursday, Morgan Stanley, some other industrial type and financial names on Thursday too, and then finally on Friday, which is usually a light day. Fridays and Mondays tend to be light on the earnings front. Schlumberger is the bigger name that we have due out that day. A few other kind of smaller banks, and then Kansas City Southern and some more industrial type names as well. So that's our week ahead. So a pretty busy week, especially for the financial sector, especially for this industrial sector, Netflix as well, and also a busy week on the economic front. Philly Fed, we missed that. Housing starts in Philly Fed on Thursday. So a lot of action that could, again, provide from a macro level some volatility that can fuel any kind of pullback that we might see in the next week or two on the short-term basis back down to that 2,500 level area. I don't think we have enough here that would bust us through 2,600 to the upside and really significantly break up to that 200-day moving average right now, barring any unexpected headlines, as in especially anything related to trade war resolution, which I doubt we'll get in the next week. Alright, for our trade idea, let's take a look at here Netflix, which has earnings coming up here this week. One of the few major non-financials or industrials to have its earnings announcement. You can see the rally it's had up to a recent high point, but it's also very volatile. Look at the Bollinger Band width, very, very volatile here. We've been volatile like this coming out of an earnings. It's not too often that we're this volatile heading into an earnings. You can see even here, heading into this earnings, we were low on the volatility. And over here on this earnings announcement, we were starting to ramp up a little bit, but not an extreme like we are right now, which you combine the fact of the earnings announcement and the big moves, and you can see that it creates an environment, a situation here. Here, let's look at the highest extrinsic value. You can see right around this 335 area, 332.5, kind of equal here. You can see up a little bit in the after hours than where we finished on the day. So if I were to look at, say, and you can see there's about a $30 difference. So if I were to add or take away $30, I can look at selling this 302.5, make about 415 bucks of extrinsic value. And if I come over here and add $30, I can sell this 362.5. That gives me another $430. So I'm getting about $871 here of extrinsic value now to protect against a big move. So that's, you can see I've got the high implied volatility. We know the extrinsic value for that's all going to go to zero. Now depends on whether there's intrinsic value, so we have to finish outside of that for there to be any intrinsic value. So I've got about $8 in either direction as a break even. Now in case we do make a big move one way or the other, kind of outside this expected range, see this is a $30 expected range, plus or minus 30 bucks here, and you can see the market maker move about 27 bucks from where we're at. So it kind of fits within this range. If we were to go outside of that, then we can go and look at these March options here, where the volatility is a lot lower, and protect against that. So we'll buy the 300 on the put side, and we'll buy the 365 on the call side. So these end up being diagonal spreads. So if you were to hit confirm and send, about $2,000 if you were to add up the buying power of doing the call diagonal, the 362.5, 365 call diagonal. And so again, what this ends up being essentially is I have a calendar spread at the short strikes at 362.5 and 302.5. When I roll those at the end of the week to March, then I end up with vertical spreads. I can roll these, or I can roll these to the next week and the week after that and the week after that. I can just keep rolling them from one week to the next. But I do know at least at the end of this week, I will lose all that 870 some odd dollars of extrinsic value. And if you take a look at the Analyze tab here, here's the, let's get rid of, here we go. So there's the trade, right? So there's the diagonal spread that we just put on. This is the two trades separately. So here, let's do this and this. There we go. So there are the two trades separately. One cost me $964 to get into. One cost me about $870. These are all debit spreads because I'm paying more for these long options than the credit I'm receiving here. So you add that together plus some, and that's where you get the $2,000 of buying power. Let's see if I were to do this, you can see, you know, the buying power effect as we saw right here, $2,000 or so, and at least in this account. Now you notice that in between 302 and 362 and a half, as long as we stay in between there, then there's my gains. And you notice that between now reset parameters here, now and the end of the week, there's a pretty decent chance that we will close in that area. About an 85, almost 86% chance that we will close inside of there. And of course, if so as time passes, you can see here the purple line will move its way up, and you also notice if volatility were to decline, especially in that front month, let's say decline 40 points because it's so high. And now you can see, you know, again, even without a change in the date, you can see the difference that makes, right? So there's tomorrow, there's through the end of tomorrow here, and this is tomorrow with a drop in volatility. So as soon as the earnings come out and volatility drops, then you'll see that purple line will really jump up. And if the stock moves up towards 62.5, then I've got the potential of making roughly $1,300. The green line, max gain on the $2,000 buying power. If it goes to the bottom, then I can make still about $900 out of the 2,000. So anywhere in the middle, and I'm making around that $600-700, and I can just close out the trade as soon as earnings done. I can roll it if I want to, if it looks like it's staying within, and if I hit my slices, set these slices to the chart of Netflix. So there's my short strikes, right? If it stays within that range, there's 362.5 on the upside up here, and there's 300. If it stays within that range, I can roll it from 1 week to the next, or I can just close out the trade and move on, which is the most likely scenario. Now, when volatility is really extreme like this and starts to ramp down, a lot of times that means we go sideways. In this case, by the time we did go down, we ended up sideways, but there was some ups and downs in between. So keep that in mind. There can be some volatility, even if by the time we get from these extreme levels back down to these lower levels, we end up just flat. That doesn't mean in between that we don't go higher or even lower after we get this expiration after earnings. So that's just a quick and easy way to make a high probability trade, as you saw here. A high probability trade if I were to set slices to break even at expiration, and then reset parameters here. Pretty decently high probability trade for the stock. In fact, if I set the slices to the charts, there's my break even. So we'd have to break out of these old highs to the upside, or break down below this November high point to the downside. So there's some resistance, and it doesn't mean that we can't do that, because stocks can definitely move outside of their expected range. But considering that we've already had such an extreme move to get here, the Bollinger Band width is already high, it gives us a good opportunity to stay in the middle of the expected range, because we've already had the volatility heading into the announcement. Alright, that wraps us up for today. Now I want to hear from you. There's a link popping out in the top right corner of your screen that will take you to our forums. Post any comments or questions you have for me there, or anything you want to discuss with other market scholars about something that's in the video or something that may not be in the video. You can open any thread and open any new thread, or reply to anybody's thread in our forums here. Remember, you have to subscribe to our site, but you can do that for free to participate at least in this particular forum. The other forums you notice for the classes are all premium forums that come with your subscription to those classes. Again, thank you very much for watching tonight. I do appreciate your time. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment down below. Follow us on Twitter for more content throughout the day. and join our community that we've created on Facebook for the Market Outlook video, as well as on our website at marketscholars.com. Thanks again. Have a great evening, everybody. Rest of your evening, and we'll see you all next time.